So, I like American stocks, and yeah, I missed out on emerging markets running up this last year, but I still like American stocks, and I like to get paid when I buy American stocks or exchange traded funds. So, generally, I trade exchange traded funds, BDCs, and any of that pays income, even closed end funds. That's why I got ADX on there because ADX is badass. But if we were going to look at the 1 year change just in price action per ETF or closed end fund or income fund that's on this list, you see a massive difference between some of the ones that pay a higher yield and the ones that are more manageable in their yield, the 12 to 14% range or even less, like ADX is 8% roughly, right? And it's doing the best out of all of them just on the price action. If you look at all these funds that pay in excess of 12%, they're far down. Look at XDTE. That's your NAV erosion for you, 22%. So if your price is coming down, what's happening in the dividend income? It's coming down too. And you know what? We're in a bull market, man. We've been going up exponentially over time, making new highs, and XDTE is underperforming on price. What's that tell you about what's going to happen in the long-term horizon for funds that pay too much yield? Okay, that's poor management, guys. That's a return of your capital, and not just for tax purposes. They're draining the fund. All right. We look at what we did on a return basis, on total return basis for the last year, and the yields that are paid for each one of these. You see a contrast where some of those high yield ones have moved up the ladder a little bit because they're paying out so much in yield. So like WTE is at a 35.84% yield for the last year and a return of only 11.37%. You see that contrast? Now ADX only pays you 7.81% trailing 12-month dividend yield, but has a 1 year total return of 21.93%, beating the hell off the pants of a 35% yielding fund like WDTE, because WTTE, I keep having to pronounce that thing, fucking pays too much. It's selling off. It's dropping like a rock during a bull market. That's a danger signal, guys. If you get into a bear market or a decent correction, that fund's going to get wrecked. I'm just telling you, that's my belief. So if we do get a pullback relative to anything going on with the headlines now regarding the rate thing that they're doing with the Fed, the New York Fed's trying to bail out the Japanese yen. We get one of those yen carry trade sell-offs. Some of these funds are going to do disastrously, and they're not going to recover their NAV at all. Whereas other funds over time have proven that they can recover their NAV. Primarily, in my opinion, would be ADX, SPY, GPIX, and to a lesser extent, maybe T-SPY. I think T-SPY is a little aggressive on the yield front too, to be honest. It's paying out 13.74%. How is it beating SPY? You might say it's because it does zero data expiration options, and as a result is delivering on more, income based on that. But if you look at share price, though, it's a different story that's being told, in my opinion. It's down for the year on share price. So there's some return of capital, and it's not just for tax purposes. It's because they're draining out the assets to a certain extent to pay out the yield that they're paying more on. Whereas SPY has some price appreciation. But other funds that are more conservative when it comes to paying out on yield are doing better on their price appreciation for the last year, like GPIX and obviously ADX. All right, guys, so be careful what you wish for. You're chasing a high yield. You got to look at a total picture. And keep in mind, as these funds drop in share price, that yield that they're paying out is on a smaller share price. You understand that? Their dividends drop. So if you're planning events on your life for the next 20 odd years of retirement and your yield keeps on going, your distributions are basically going down because your yield is on a smaller share price, you're going to get wrecked over time. You're going to have to budget differently. And if you've got funds like WDTE and XDTE that don't recover share price very well at all, then you're in trouble long term. Now, if you're going to die in 10 years, maybe you'll make it and only lose 50% of your distribution money over time. But the reality is, guys, we don't know how long we're going to survive, right? So I'd rather be in funds that going to have some longevity to them. And for that reason, the only funds I like on this page really are the top three that you see: ADX, GPIX, and SPY. iSpy probably deserves some sort of mention. T-SPY, only during a deep sell-off would I really position a lot of shares on that, because negligible on how it performs on its NAV. All right, guys, careful out there. Careful what you wish for, and don't chase yield for just the sake of a fast return right away. Look for longevity. Honestly, only one of these funds, maybe two, has any kind of longevity, and that's primarily ADX has the longevity. As far as performance, I like the top three. All right, guys, take care. Bye.